that's going to take us back now to Mike D's question. Then we've got those couple live questions coming in. This is also going to relate sort of to William's question in a sense. William says, do you consider the Iron Condor as a beginner's option strategies? Well, let me just address this first, William. We just went through a discussion. It might not have been the best discussion you ever seen. Might have felt like we went through it quickly with the discussion of Delta, in that case for Robert, related to that. And we talked about the gamma. And I mentioned implied volatility, I mentioned probability, William. If any of those terms, at the money bell curve, even percent time value, midpoint time value, William, if any of those terms are sort of off to you, that you don't understand them, or you felt that I went through it too fast, you couldn't follow it, you say, I know what delta is, I know what probability is, but I don't know how it relates. I'm going to say Iron Condors might not be the best strategy to start with as a beginner at all. You've got 4 working legs. You have 2 ways to lose. Look at the market over the last 3 months, from mid-December to now. And say, oh, Iron Condor is a good strategy. I said to pick the point where stocks didn't hit. Stocks were breaking the upper bear call sides left and right during that time frame. And remember, with an Iron Condor, it's a great-looking leveraged position where you might be making, theoretically, 20, 25%, 15% against the true risk on a position. But the Iron Condor is as neutral to a neutral position as you can be. Shorter term, and I know a lot of people are touting these 0 days to expirations, spreads, and so forth. Oh, no, wait, I didn't want that one. I'm sorry. Hold on. There we go. So here's just a bunch of ones on SPX. And when we're talking about 28% return against the margin, 25% return, 80% probabilities the stock will be between. What does that mean? I'm doing a bear call credit spread and a bull put credit spread. Oh, I should have left that up. I apologize. I'm doing a bear call credit spread and a bull put credit spread on the same stock. And here, 12 days out in time, yeah, I can use 1 day out, 2 day out, 3 day out, William. This is where it's also getting complicated on the indexes. We're at 51.23, 52.75, and 49.65. As long as the stock stays within that range, and theoretically in 12 days, there's an 80.8% probability we saw that the stock would stay between these two strike prices, that's great. We'd make a 25% return. All 4 options expire worthless. But just as we sort of talked about with the buyback cost of the call, if it shoots up in price as it did in Don's example, and the implied volatility increased, it cost more to buy it back. He couldn't maybe lock in that profit. As this starts to swing up, you're losing on the trade, right? This is the halfway point between now and expiration. 1, 2, 3 days out in time, if the stock moves up or if SPX pulls down, you're going to probably be in more of a range like this in the loss zone. You got to hold it closer to expiration to get that time decay in your favor, as well as the stock not moving outside of the bands in this range where you're going to start to see leverage risk. Why is that important? You can lose 100% of what you invest in this position. So what? I open a credit spread. I open an Iron Condor. By the way, I like bear call credit spreads. I like bull put credit spreads, but I tend to be directional rather than trying to be neutral, especially in the last 4 years of the market, from 2020 till now. 2021, okay, Iron Condors, great shot. Melt up market, right? We'd move up 2 to 3% over a 30 to 45 day period, and then maybe drop 0.5% or 1%. Then we'd move up 4 or 5% over the next 2 months, and then drop 1%. That's called a melt-up market. It's a perfect situation for Iron Condors, especially on the broad-based indexes. Fast-moving stocks, fast-moving AI stocks, trying to catch the trend, trying to do this, trying to get the better premium because the better implied volatility. I've got a 4-to-1 risk-reward ratio. That's great. I mean, that's better than what I'm going to show you in a couple minutes, William. And it's a 25% return, as long as the stock stays between the strike prices in 12 days and both options expire worthless. Oh, Mike, you're saying I can lose 100%. Big whoop. I can lose $400. Why are you entering an Iron Condor? You're likely looking at iron condors and spread positions to take advantage of the leverage. Leverage works both ways. What do I mean by that? I just showed a married put on Trex that would have cost me about $10,000 to get into. The married put that I'm in did cost me $10,000 to get into. It was 100 shares of Trex at 89.53 about a month, or on February 15th, I think it was. Sorry, about a month ago. And I bought the July 95 put for $10.95. So it's $10,000, $10,044, William, I've got invested in the position. And what do I have so far? The stock's up 6%. I have a 2.2% return on the position, I think we saw. And the married put, when we looked at it, what's so great about that? Well, remember, if Trex did the opposite and dropped down to $70 per share, the most I could have lost was $450 or 5.5% on that position. Saying, yeah, Mike, I'm still doing better than you. I'm risking only $400 in the absolute worst case scenario. And in that case, I'd say yes. If and only if you're a disciplined trader. You and I both had $40,000. I used 25% of it to enter the Trex position at $10,000. And you say, I like this SPX weekly Condor 12 days out in time for the 20th of March. I also have a $40,000, $50,000 account. I'm sorry. And you know what? I can have lower risk than Mike for just $400 monetary dollars. But you're not going to do that. You're going to do 5 contracts. You're going to do 6 contracts. You're going to do 10 contracts, meaning now you're risking $2,000, $2,400, $4,000, 10% of your entire portfolio in one trade. Okay. Now, one more quick thing here to talk about, and this is going to lead into your emailed question, Mike D, so just bear with me one second. Not too much of a move, but we were close to 5,200. We were 5,250. We've almost flirted with 53. Let's say at 5,250 here from now. Okay, so let's go next week. 6 days out in time. Not too bad. SPX goes up to 5,250. The short call is going to really move up in price from the concepts we discussed today, the delta, the gamma, at the money bell curve, right? It's getting closer to at the money. Estimated price is 2,283. Yeah, your long is going to gain as well. But remember, this is a 5-point spread. At this point, it's going to cost you $250 to close it. You're still making a profit, and you're making more of a profit over here on the bull put side. So yeah, I'm only taking a loss of 98. And that's what? Let's call it $1. That's 25% of what you invested, or the maximum risk you lose on the trade. I'd probably stay in it at this point, but now it starts to get closer and closer to that 52.75 strike, and this risk is going up from $1. Loss is going up from $1 up to $2 of a liquidation loss or needs management. Why is this even important at all, William? Because he also commented, I'm spending a lot of time recentering the trade. Yeah, because the markets are moving quickly up and down. You're trying to stay equidistant between your short call and your short put strike price. Or even if you're doing, trying to follow some of the other ideas of management, you're trying to stay in a delta range by rolling the call up and down, rolling the puts up, the sold puts up and down, moving the strike prices, doing that, doing this, to stay in that 80% probability, to stay in this delta ratio you want. And all you're doing is managing. Well, this isn't a big deal. You lose $2. You decide to liquidate it to get out instead of keep recentering it when it's taking up all your time, it's taking up all your commissions, removing these Iron Condors. That's a problem. Now, this is the problem too. I was just harping about, hey, I was risking 458 on that initial married put. You're risking only 400 on this Iron Condor. But the lie of leverage does tell me, and 20 years of working with Ernie and Power Options tells me that most investors aren't doing one contract when they get to a leverage spread. Again, they're doing 5, 6, 10, 20, 25 contracts to sort of maximize the monetary premium. $2, when you hit a 50% loss on a spread position, even at this point, when we lost the $1 in that theoretical calculation I just did, William, why is that important? Like I said, the leverage works both ways, what's known as the martingale, gambler's ruin. If I have a 10% loss on a trade, do I need 10% to get back to break even? No, I need 11.1% on what I have remaining to get back to break even. 25% loss on a trade. I lost that $1. And that theoretical, let's just show it again, that theoretical calculation we did, if the stock moved up to 52.50 in a few days on March 14th, 6 days from now, we'd be at a loss of about $1. 25% of what? The maximum loss on the trade. Say I did just put in one contract though, and I only had $400 in. I lost 25%. I'm now down to $300. What do I need to do to get back to break even? With a 25% loss, I need a 33% gain to get back to where I started. You take a 33% loss. I bought a call for $1. It fell in price in that case. And so it's at 67. What do I need to get back to break even to my $1 cost? I need a 33-cent gain on the 66, 67 cents I have remaining. I need a 50% gain on what I have left to get back to break even. And if I take a 50% loss, I lose that 2 points. What do I need to get back to break even on the money I have left from this trade? I need 100% gain on those $2. That's the martingale. That's gambler's ruin. That's the lie of leverage. Yeah, I can make a 25% return, but I've got to control risks to a certain range. Otherwise, I'm not going to see the gains I need realistically. By the way, is it divided by 10? In other words, if I take a 50% loss and we need 100% gain to get back to break even, if I take a 5% loss on a trade, do I need a 10% gain to get back to break even? No. I only need a 5.3% gain to get back to break even. That's the benefit of the leverage. Now, I apologize, Mike D. I'm going to get to yours, but I think this is a perfect lead-in to what you're going to hear me babble about in a moment, even further. But continuing on this with William, he also adds, I'm only seeing about a third of my net credit. Okay, as a teaser, Mike, you've probably already, since I've spent so much time talking about them today, you've probably seen one thing. Remember back to Mike's question by email, Mike D. First, he says, what do you recommend for stop loss orders? We'll talk about that in a moment. He says, what are or is your favorite option strategies? And I made a crack that some of our regular attendees here, such as Kip, oh, don't worry, William, I'm going to show you something in a minute I think you want to stay around for. Yes, I know we're at 6 o'clock. We're going to handle these two as well. But Kip and some of our regular attendees that we always have here. Let's see who's in attendance today here. The Harry I've seen before. Anthony C is with us from time to time as well. Let's see here. I was looking. Yeah, Pat H. Yep, and some others. Okay, but anyway, they've heard me say this ad nauseum, and in most webinars you hear me say this. 50% of my trading portfolio, options trading portfolio, is in married puts, Mike. Married puts and collar trades following the rules in the blueprint. Why? Because to stay in the game longer, it's capital intensive. That's why 50% is there. But I hit my targets for this strategy consistently. And as I'm trading this, the most I can lose is 5, 6, or 7% guaranteed on the investment by the structure of the put. No, it's not a parity trade to a long call, because a long call you can still lose 100% of what you put into it. But that means I only need about a 5.3, 6.4, 7.3% gain to get back to break even if I take the full loss, which I don't. My average loss in the married puts, I think, is about 4.8%, which means I only need about a 5.1% gain on a loss to get back to break even. And I average, I think, 6% on my winners. And I have an above 50-50 win ratio, staying ahead of the game. But that's 50%. What am I doing with the remaining? Yeah, I like credit spreads. Bull puts. You've heard me talk about those. I like the structure that we created with the search, the testing I did, the trading I did. 2-week out bull put credit spreads with an 85% probability, looking for about a 15% return. And usually we get that success rate, but we don't trade it in every market. We may bounce forth from bull puts to bear calls depending on the market sentiment tool and power options. But yeah, that represents 15% of my account. Why 15% only? This is the most profitable, by the way. So why is it only 15% of my portfolio? Because what you've experienced, William, if I'm not consistently managing the positions, which I really can't do during the day, if I can't close the positions to keep within the lie of leverage and not allow the losses to go beyond 50%, but even if I do that, there will be times almost every 18 to 20 months where I'm going to see a 50% drawdown on the credit spread portion of my portfolio. Even with management, even with rolling, it's an inevitability. The black swan events, every 18, 20, 21 months, I see that happen. But when it does happen, it hurts. I hate it. But even with that, with 15% of my portfolio, that's only a drawdown of 7.5%, which means I just need to make back about 8% on what I have remaining in the portfolio to get back to where I was. We never suggest doing more than 10 to 20% of your total portfolio in credit spreads. My wheelhouse is around 15%. Hey, there's stocks out there that I can't afford to trade as a married put, but I will trade as a bull put credit spread. But if I'm looking for longer term growth on higher price stocks that I can't afford in my portfolio as a married put, what am I doing? Probably doing those calendar call spreads. Poor man's covered calls, but I hate that term. And you can look up the webinars and see why I hate using that term. I think it's very misleading when it's taught that way. Diagonal call spread, buying an out in time 6, 8, 10, 12 months in the money call and selling at or selling out of the money near term calls against it. I can't afford to do Chipotle as a married put. I can't afford to do NVIDIA now as a married put, even with the price of the put options. Heck, even with the price of the call options. But I could do more lever to the calendar spread. But again, that's only got to be 10% of my portfolio, because even though I'm buying an in-the-money call that's far out in time, I can still do what? Lose 100% of what I had invested into this position. Okay? And then what do I want to do? All right, what do we've got here? That's about 75% of the portfolio. I'll play the lottery. I'm going to have 2 to 3%, maybe buying straddles or strangles on stocks with earnings coming up, buying a call and a put. Hey, lottery ticket. Maybe get an extra dinner, take the family out for an extra dinner if I hit a winner, that kind of thing. Not going to be my total portfolio, not my total trading plan, not gambling here, but it's fun from now and then. And about 2 to 3% of the portfolio will have, of course, in broad-based market hedges, calls on the VIX, puts on SPY or QQQ. And if I'm in 50% of married put positions, why on earth do I need this? Well, it's to hedge this portion of my portfolio, the leverage positions, which can lose 100% in a sudden and unacknowledged adverse market conditions. So, what are my favorite option strategies, Mike D? Married puts, bull put credits, calendar call spreads, occasional straddles, out of the money bull call debits I've warmed up to over the years. A couple of the guys that are regular attendees here can tell you that. They've seen I've done more presentations on that idea of doing at to out of the money 90-day bull call debit spreads for more growth. Worked really well in some markets recently. But for me, that's about it. I'm not extravagant. I don't do ratio spreads. I don't do butterflies. Butterflies to me are worse than condors, William. More management. Management is immediately required almost in most situations to do that. Okay, so Ernie would answer it probably the same way. Mike D. Mike, he'd probably say that married puts and covered calls are what he does. He mostly does married puts now as new positions, but he's got covered calls. He's been trading on his shares of Hewlett Packard, now Agilent, for years and years and years. He's got other covered call positions. He likes to use long calls. He buys calls, both leaps, but also shorter term, 90 to 100 days out in time, following the default search we have there, the default picks of the day in a sense in that pod. So the covered call picks of the day, weekly and monthly expirations that Ernie set up, the weekly and monthly naked puts picks of the day, which you can also see under the strategies. Bull put credit spreads. That's what I like to use, the weekly expirations, 2 weeks out in time. And then Ernie's long calls, looking for sort of a breakout, Bollinger Band breakout, and other things. But again, because you can lose 100% on that, Mike, and also William, it's just, for your concept too, that is why it's only about 10% of his portfolio. Because unexpected event, not necessarily targeting earnings at all, you can lose 100% of what you invest in that position.